Hi, welcome to my second video in my investment analysis kind of overview. This video series is going to walk through my process for looking at a stock and developing a valuation model. One thing that I want to stress is this is my approach. It's not the approach. There's a whole lot of very smart investors out there that use a lot of different techniques. So don't think of this as the only way to approach it. Instead, it's just a way that I use to analyze stocks. And I'm very big on a discounted cash flow analysis model. A stock to me is a piece of a business. So I want to figure out what the business is worth and then convert that to a per share basis. And so we're going to be following Chipotle through this series. I chose Chipotle for a couple reasons. One, it's a place I like to eat. Two, it's a very simple business model. They basically make and sell Mexican food. And so it's one that everybody should be able to understand fairly easily. A lot of you have probably eaten at Chipotle. If not, make a plan to go there sometime. It's pretty good. So we start at the Chipotle Mexican Grill investor relations page. And I'm going to go to the SEC filings. Annual filings, and we want to download the 10K. Now I've already got that downloaded, so I'm just going to flip to that. It's on another screen here. And here is the Chipotle Mexican Grill 10K. Now, these are not light reading, and it's something that I've heard some people recommend reading a 10K every day. Unless you're retired or really have problems falling asleep or something like that, you're probably not going to be reading a 10K every day. But it's probably not a bad idea to get in the practice of reading 10Ks. And it's best to start with relatively simple companies. I wouldn't go and pull up a Citigroup or something like that, or Google or Microsoft. A lot of these companies with multiple divisions, it can be a real pain to go through. So try to pick a relatively simple company. That's what I did with Chipotle. And it's easier to understand the business. And a couple of things we'll see. This is going to be a quick overview of the 10K. We'll spend more time going through the 10K in detail later on. This is kind of just a highlight sheet. So one of the things you'll see right here is this is Chipotle Mexican Grill. They are incorporated in Delaware. That's where the majority of companies will be incorporated. Common stock, par value 1 cent per share. Par value is not something that's very meaningful for common stock. And the ticker symbol CMG, trades on the New York Stock Exchange. As we scroll down, you'll see a table of contents. There'll be an overview of the business, some of the risk factors. We'll spend some time going through the risk factors. I want to go through each of the risk factors in one of the videos just to give you a feel for how companies present those. And you'll see some of them are what I would refer to as more boilerplate. Our food prices may increase, and they'll talk about that. But it really gives you a good feel for what kind of risks that you might encounter as a shareholder. And another thing that we're going to spend some time on is the financial data here that we see in part 2, and especially the financial statements and supplementary data. That's where we're going to get the data to build our financial models. As I mentioned earlier, I am big on a discounted cash flow approach. So we're going to basically copy the income statement, balance sheet, and statement of cash flows. And then we're going to develop a model so we can forecast those forward for the next several years. And again, that is not the only approach to doing this. Even when you're doing that approach, there are a number of different assumptions that you're going to make. It's something that if you do, you'll get better at it, and it'll be a little bit easier over time. It does take a little while initially to set up, but I think it's good, and it helps you walk through why do you think these things, and you'll read through more details of where they're getting their numbers from, and that will help you through that process. So we're probably going to spend at least one video, more likely 2 or 3 videos, building that financial model out, and that's going to be a big part of this series. As we're doing that, we're going to read through some of the information on there. What are the assumptions that are going on? I will give you a preview. One of the things, I'm not an accountant. I've done some accounting as far as I do have my CFA, but I'm not an accounting expert. And there was a big change about a year ago. I'm filming this in early July 2020, where operating leases got moved onto the balance sheet. And it took me a while to deal with that for Chipotle. I ended up making some simplifying assumptions on there. But it's probably a good background to be familiar with accounting. You don't have to have an accounting degree, but you should be comfortable with what an income statement is, what a balance sheet is, what a statement of cash flows is. So if you're somebody just getting started in the world of investing, spend some time developing some basic accounting understanding. Again, you don't need to take accounting courses, but you do need to understand what is an income statement, what is a balance sheet, and what is a statement of cash flows. Those are three financial statements that I do use in my investment analysis. And then just some other information on the company. So as we scroll through, one of the things that you'll always see is cautionary notes, forward-looking statements. These are in all of the announcements. One of the things we'll look at later is a conference call transcript. You'll see the same thing in here. We're going to make some forecasts. We're going to talk about what we might do. Be aware that these are forward-looking statements. They're not promises. They're not guarantees. What is the business of Chipotle? Chipotle operates Chipotle Mexican Grill, which features a relevant menu of burritos, burrito bowls, tacos, and salads. It's a relatively simple menu. Essentially, you have some choices of proteins, steaks, chicken, pork, things like that. Black beans or pinto beans, rice, white rice or wild rice, and they develop that right in front of you. They first opened a single restaurant in Denver, Colorado in 1993, and they now operate 2,580 Chipotle restaurants. That was as of December 31st, 2019. Probably a different number of restaurants as you're watching this. They are international to some extent, but you can see 2,580 Chipotle restaurants in the United States, 39 international, so very much located in the US. And they do have 3 non-Chipotle restaurants, which are a very small pizza chain that they've got. What is their business strategy? Essentially, they are trying to sell burritos, tacos, and things like that, and develop a marketing image of Chipotle as natural ingredients, real food, things like that. One thing to be aware of, you're going to see a lot through Chipotle's website, things where they are marketing themselves as wholesome ingredients. This is very common among restaurants. They want to make sure that you realize that they're trying to use real food. And by real food, we mean fewer preservatives, things like that. Every company needs to establish a niche, something that makes them special. And one of the things Chipotle has done is try to create a very simple process that focuses on the quality of their food. And as you can see, one of the things they're going to talk about pretty quickly in here, purchasing and food safety. If you're familiar with Chipotle, a couple years ago, they had some food safety issues that really hurt them and caused their stock price to drop, their revenues to drop. And since then, they've made quite a comeback. So I'm just scrolling through this here. You'll see they talk a little bit about their competition, how they choose restaurant sites, and so on. Risk factors, as I mentioned, I'm going to do a video just walking through all the risk factors, but here, risk related to our business and industry. Food safety and foodborne illness concerns may have an adverse effect on our business by decreasing sales and increasing costs. If people aren't comfortable eating there, if they know there's been outbreaks, people may say, well, let's go someplace else to eat. That's going to hurt their revenues. They have to respond by improving food safety. That's going to increase their costs a little bit. And so they talk about some processes that they've gone through and some experiences. And you'll see there are several pages here of these risks. So I'm probably about 5 pages down, and we're still getting into more risks that the business could face. Unresolved staff comments, none. What are their properties? 2622 restaurants operated by Chipotle, 2,619 of which were Chipotle restaurants. We talked about that briefly before. And here we get into their total returns. Not every company is going to have this in their 10K. Chipotle does. They go back to 2014. The red line down here is Chipotle. You can see they greatly underperformed over the first few years. And then the last couple of years, they have outperformed. And that's still been going up since December 2019. Here we see this kind of dashed line, that is the S&P 500 restaurants, and this blue line is the S&P 500 itself. So restaurants have done the best over the last several years. S&P 500 has done well. Chipotle's a little bit higher, it looks like, than where it started, but not a great return over time. And here you can see the numbers, essentially $100 invested in 2014 was worth $122 at the end of 2019. Same $100 invested in S&P 500 restaurants was worth almost twice as much at $222. Selected financial data. Honestly, I don't spend a lot of time looking at this because I'm going to go get the financial statements themselves a little bit later on. So as we scroll through, here you'll see some of their restaurant activities. And one of the things that I mentioned is they do have these pizzeria locale, that there's 3 of them that they have open right now. But it talks about beginning a period, how many they had, how many opens, how many closed. And notice they've closed a few each year, but they've opened quite a few more. Results of operations. This is something that's worthwhile. And here what you want to look at is comparable restaurant sales increases. So if we look at 2017, restaurant sales went up about 6.4%. That's higher than inflation, so that's good. Up about 4% in 2018. Not quite as well as 2017, still positive, but not super impressive. But 2019, now that's a big jump for same store sales. So that is pretty impressive there for Chipotle, 11% increase in sales. And then you can see some of their individual component costs, labor costs. Now this is one of the things that might be a little bit surprising if you look at labor costs. In 2017, they were 26.9% of sales. 2018, 27.3%. 2019, 26.4%. So even though we've seen pressure on minimum wages, because of their growth in sales, they've been able to keep that percentage of sales actually down a little bit over the 3-year time period. Occupancy costs, other operating expenses. And again, we'll go through these in more detail in future videos. This is one that's, I think, worthwhile to look at, is that provision for income taxes. One of the important things that's affected stock market values over the last couple of years, and again, I'm filming this in July 2020, is the Tax Act that went into effect at the end of 2018. So in 2018, they paid 34.2% effective tax rate. 2019, they paid 23.6%, which means a lot more money was left over for shareholders. So that tax cut is a big factor in creating value for corporations. Now, one of the question marks, at least in the US, we've got an election that's going to be coming up in a few months in November. Depending on the results of that election, we might see changes in corporate tax rates again. They might go back up. If so, You want to model that in your valuation analysis. And one of the things that you probably want to do is say, well, I think there's say 70% chance or maybe a 30% chance, whatever you think is appropriate of what that change is going to be, and incorporate that. So you have to think about what these things are that might drive value. And I see we're getting about 15 minutes. So I'm going to wrap this up pretty quick. Contractual obligations. So I mentioned the idea of operating leases. Leases used to be off balance sheet. Now they are on the balance sheet as obligations that the company owes. So the company has about $4 billion in operating leases that they have to worry about. Those are going to come off 2020, 294 million, 2021 to 2022, 340 or 643, 675. And then after 2024, they're still going to have about 2.5 billion. Purchase obligations, things that they've agreed to buy. So this could be things like their ingredients. They work with a lot of small farmers, so those are going to be in there. Let me scroll down here to the financial statements. And this is where I'm going to pick up in our next video. So we've got the balance sheet, the income statement, and then there's the statement of shareholders' equity. I personally don't use this, so we're going to skip over that one. But the statement of cash flows, that's a big one. That's what we're going to forecast, because what we want to know is free cash flows. I mentioned I use a discounted cash flow analysis method, and so we need to forecast the discounted cash flows. And so what we're going to do is forecast this net cash provided by operating activities. We're going to look at their capital expenditures, which is purchase of leasehold improvements, property and equipment, essentially opening new stores and improving their existing stores. And what's left over is money that's available for shareholders. But we know the historical data, the value of the stock is based on the future data. So we've got to project what that's going to be. Now, I often joke to my students when we're doing valuation, all we have to do, and that's a very sarcastic all, is forecast every cash flow the company's going to generate from now through the end of time, choose the exact correct discount rate, and solve for present value. We can't do any of that with accuracy. So there's going to be a lot of assumptions and guesswork in there. And when we do the valuation model, we're going to have to remember it's not a very precise process. It gives us an approximation, and that approximation is going to be based on a lot of different assumptions. So let me wrap this one up, and I'll have another video, a couple of videos on building the financial model coming up next.